Building owners may be quietly walking away from 6 or 7 figures in legal tax deductions on projects they've already paid for simply because they're unaware that they exist. I'm talking about Section 179D, a deduction that pays you for making your buildings more energy efficient. And here's the kicker. Under the big beautiful bill, 179D is ending for new projects. But if your project starts before June 30th, 2026, you can still lock in this deduction. Today, we'll break it down for you.
Welcome to the Tax Strategy Playbook, the show where smart investors, business owners, and real estate pros learn how to win the game the IRS wrote. Each episode, we break down powerful strategies, expert insights, and real-world examples that help you keep more of what you earn. Because here, it's not about working harder, it's about working smarter with your taxes, because tax evasion is a crime, but tax avoidance is mandatory.
Welcome back to the Tax Strategy Playbook, the show where we give real estate investors and business owners practical strategies to cut taxes, boost cash flow, and build long-term wealth. I'm your host, David Wiener, also known as Mr. Cashflow. Today we're doing a deep dive on 179D, what it is, how it works, what changed under the big beautiful bill, and exactly what you should do if you have projects that started or will start before June 30th, 2026. And this is just part one. Next week, we're going to bring today's guest back for a separate deep dive on research and development tax credits. So if you're serious about tax incentives, make sure you're subscribed so you don't miss it. Joining me today is Brian Broussard, a colleague of mine and the executive vice president at CSSI. Brian leads their 179D and R&D energy efficiency deduction practice, working with building owners and designers across the country to unlock major deductions on commercial projects. He spent years in the specialty tax world, helping clients and their CPAs identify, calculate, and defend 179D deductions on everything from office buildings and warehouses to educational and government facilities. Brian, my friend, welcome to the Tax Strategy Playbook.
Great. Thank you, David.
Let's get started with this. When you sit down with a building owner who's never heard of 1D, how do you explain what you do in one simple sentence?
Sure. I just really simply put it as it is a commercial building tax deduction for the energy efficiency of that building. It's really straightforward.
Okay, so let's kind of lay the foundation a little bit so everybody's on the same page. In plain English, what is Section 179D and what kind of projects does it actually reward?
So the 179D, energy efficient commercial building tax deduction, is that exactly what that is. It is a energy efficient tax deduction based on the energy efficiency of that current building, looking at the lighting, the HVAC/hot water systems, and the building envelope. And basically what we do is we look at these buildings, we evaluate them based on the systems that are installed, and there can be a tax deduction available on the square footage of that building.
So who can qualify for it? Is it just owners of the buildings or designers, or what about tax exempt projects?
Sure. So primarily building owners are the ones who are going to benefit from this 179D tax deduction. However, as you mentioned, there are buildings out there that do not have a cost basis or non-tax paying type entities. And in those situations where we're dealing with a government project or, again, a nonprofit or a non-tax paying entity, that energy efficiency of that building can be allocated to the individuals responsible for the design of those energy efficient systems. So typically your architects and engineers can benefit from that.
Oh, that's pretty cool. I bet a lot of them don't even realize that.
No, some of them don't. It's amazing. This has been around since 2006, and every day we're running into different designers who are not aware of this.
And this works for new builds as well as it does improvements, right?
Right. So basically, any new construction project, can qualify for this deduction. Also, if you bought a building and you did renovations to either the lighting, the HVAC or hot water systems, or anything having to do with the envelope, which includes, the four walls, windows, doors, as well as the roof.
Okay, that's good. Under the big beautiful bill, which we all waited for because of the cost segregation aspect and the bonus depreciation, D was the downer. So it's ending for new projects, but it still applies to qualifying projects that start before June 30th, 2026. Exactly what does that mean? How does that project start date work in practice?
Right. So basically, 17090 is sunsetting as of June 30th of this year. You can still claim the deduction as long as the construction for the project has started prior to that date. So when you're thinking about what construction means, it doesn't include land clearing or anything like that. It has to do with the actual physical building. So think about maybe the slab being poured as that footprint of the building being started. As long as it starts prior to that date, you can still get grandfathered in regardless of when it finishes. But we can go back. So we'll talk about that as well. It's not just because it's going away for future stuff doesn't mean we're losing it for prior years.
Well, that's good. Now, okay, so pouring the slab is kind of when the construction starts. What if somebody's doing improvements? Is it when they start the improvements or when the improvements end?
Right. So they've got to start the improvements. And the way the code defines start of construction means that the taxpayer or the building has to incur at least 5% of the building costs prior to that date, or 5% of the physical construction has started prior to that date. So it's not an and, it's an either or that they can meet for the start of construction.
Okay, so if I was doing improvements on my building and I pay in advance on the improvements or pay a deposit on the improvements, that's considered the beginning of it, right?
Yes, as long as it's 5% of the total building cost.
Which in most cases, I think it probably would be, but maybe I don't know.
Those systems can be kind of expensive.
That's true.
If you're buying an HVAC or a chiller or something like that for your building, it's pretty easy to meet the 5%.
That's good. That's great. So let's take a look at what it looks like in the real world with some actual stories. Can you walk us through one of your favorite 179D success stories, maybe a single building where the deduction really moved the needle for somebody?
Sure. There's actually a couple we can probably hit on. One of the ones that we typically do, I do a lot of, is hotels. Whether it's just a simple Marriott little suites, those home two suites, or Candlewood stays suites, where they're 3 to 4 story hotels. Those are pretty straightforward. But then every now and then we'll get one of these really nice hotels that's 17 floors, probably $150 million project, and it's all new, modern type of equipment in there. And those are really ones that we really kind of enjoy doing because they're just really neat hotels. They're not just the cookie cutter hotels. And those, when you add up all the square footage on those projects, those deductions can actually be fairly large. We get close to $1 million in deductions with some of these projects.
That'll move the needle, won't it?
It does. Those are really good ones.
I know I was talking to a client of mine who built a large office building, and I was talking to their CPA, and we were talking about cost segregation. And I said, have you ever considered D? She wasn't aware of D, didn't even know what it was. And it saved them a ton of money.
Yeah, that's one thing with CPAs. They're familiar with the cost seg, but with 179D, it's a different process. And I'm sure we'll probably go into that a little bit later in the cast. But typically with 179D, you're going to need someone who's experienced in the IRS modeling software. And you also have to have a licensed engineer that actually has a seal in that state. So that's just part of our process that we have to go through, whereas maybe cost segregation, some CPAs might try to do it on their own and it doesn't require an engineer. But 179D is a different process.
Well, when I told her about the 1D, the CPA, she was pretty excited. We wound up doing the study for that client, and the cost segregation saved him a ton, and the 179D saved him a ton as well.
And that's what's great about both of them, is that some people don't realize that when you do a cost segregation study, if you also qualify for 179D, they actually complement each other. You can do both studies for double the benefit that you wouldn't otherwise know about.
Well, because when we started with cost segregation studies, I can only affect everything but the structure of the building. And now that we're able to do the 1D, that addresses the stuff that we can't touch in a cost segregation study, the building envelope and all of that kind of stuff. So it's almost like a double cost segregation study.
Yep, we do a lot of studies that are combined cost seg and 179D. Again, 179D comes off of the 39-year or the 27.5-year life, and cost seg hits off that 20 years. So when you combine them both, they become pretty powerful tax incentives.
Is it is it hard? Now, we talk energy efficiency. That's kind of subjective, right? So is it hard for the building to qualify for that?
Actually, it's really more objective, right? With 179D, it's more math based, and the reason why it is more math based is because we actually have to use the IRS approved software. There's about 20 different softwares that the IRS allows for us to use. We use one called eQuest, but the way the process works is we take the building, we get the drawings, we model that building up in the IRS software. We put all of the systems in there. We put all the lighting in there. We put the envelope. And once we're done modeling it, in the same software, we draw what we call as a base building. And that base building of similar size, we input the ASHRAE standards of 2007. So if you think about that, that's almost 20 years ago. And when you compare that base building to our current building to get to an energy efficiency threshold of 50%, it's very easy to do it, because everything almost nowadays is just so energy efficient than what it was 20 years ago.
I was going to say, compared to way back then in 2007, I would assume most everything you're going to do is going to be more energy efficient these days, especially with the focus on energy efficiency.
It's almost the standard now. I mean, to put that in perspective, the 2007 ASHRAE standards doesn't even mention LED lighting. And now lighting is almost, a standard go-to on everything.
So if a client that you saved money on a 179D project prior, if they came to you today, how would the June 30th deadlines factor into your advice?
So if they had a new project that was coming up, one of the things we would, kind of mention is that with 179D, while it is going away, we still have time to enact, a study as long as you get started prior to that date. So then we'll talk to them about, their project. What is their estimated start date? If it's after that date, then we'll talk about maybe ways that there can be purchases of equipment, to get to that 5% threshold, so they can actually still claim it, as long as that construction is continuous. And I mean by buying the equipment, but not starting a year later, right? It's got to be kind of continuous going on there, no long pauses. Then there's the potential that we can go ahead and get grandfathered in for that 179D, and again, tag team it with cost segregation and bonus.
Sounds like a good deal to me. And I'm aware that there's, like we said, there are a lot of people who are just not familiar. I assume, just like cost segregation, there are some myths out there about 179D. What are some of the biggest mistakes you see building owners and designers making with it, especially now that there's a deadline? I had a CPA tell me, no, that's only for huge projects. How would you answer that?
That's a good question. So the process for 179D, it's really based on a couple of things. It's based on the square footage of the building, the tax year that it's put in service. And, the cost of doing a 179D study is a little bit more involved than a cost segregation study or any other types of tax deduction studies. We do require to have a licensed engineer, and we do have to have a modeler that can model this up in the software. And so when we're looking at buildings, ideally the sweet spot where, the client can get a decent ROI on their investment with this tax deduction is about 40,000 square feet. We can go smaller, but then it really gets to a point where the cost of the study can almost, equal or outweigh the benefit. So we try to stick around that 40,000 square foot, or larger building for these projects.
And I've heard you say in the past, if somebody doesn't have a building that's 40,000 square feet, but they have 2 or 3 buildings right in the same location, that it may be well worth studying those buildings, because once we send that engineer there, he can visit all the properties.
Right. And that's the main thing, is that whenever we have to send an engineer. Actually, and my engineer is located in Houston with me, but he does have to travel to that site. And, if the building is small and it's kind of, in a one-off area, that gets to be kind of expensive, for us to go take care of that type of study. But if we're able to, maybe group 3 or 4 buildings that are, say 25, 30,000 square feet in the same kind of vicinity, same city, area, then we can kind of group them all as one and treat them as one site visit and one review, even though they're going to require separate studies. So, that is true, that we can group these together and kind of make it to where it's still a bit more beneficial for the client versus like a one-off that they would have to go visit.
And I think the most important thing probably is we want to make their benefit worth the expense. And so we'll kind of guide them that way to make sure
Right.
that what they're getting is worth what they're paying.
Right. And they're going to know that up front when we put a proposal together based on the information that we usually get up front with the building size, the year it's put in service, and the location of the project.
Do you have a story about somebody who almost walked away from it and how you helped them recover it before it was too late, or get into the once opportunity before it was too late?
You know, not necessarily someone who almost walked away from it. We did talk to a few people that once they did a cost segregation study, they weren't sure if they wanted to do the 179D. But after discussions and explaining how that process worked and how the benefit actually was going to really increase, and this was really before bonus was actually back in effect, when we started getting down to about 40% bonus, there was an ability now to add the 179D component to their cost segregation study and give them a much larger deduction in that year one. So even though with bonus being at 40%, I guess it was last year, they were able to add more deductions in year one, kind of like, getting almost 60 to 80% bonus. So there's been those situations where, we've been able to talk to people and explain that, hey, listen, this is just as good as almost, getting bonus at 100 or 80%, even though technically it's at 40, we'll just add 179D to it. So it's your deductions.
I can't imagine that cost segregation study would be so troubling and painful for somebody that they wouldn't want to do another different study that's going to save them money, because a cost segregation study relatively is very simple.
Mm-hmm.
You said it has to do with the year that the building was placed into service, or the improvements were placed into service. And I know
Right.
there's a way that the dollars per square foot vary. Can you kind of go into that just a little bit?
Sure. So when 179D was enacted back in 2006, from 2006 to 2022, the deduction was $1.80 a square foot. Technically in 21 and 22, it went up to $1.82 and $1.88, but that was adjusted for inflation. But basically, it's been $1.80 a square foot for that time frame. Then in 2023, after the Inflation Reduction Act passed, the deduction actually dropped from $1.80 to a sliding scale of 50 cents to $1 a square foot. And then that's also adjusted for inflation for each year. However, they also implemented a bonus deduction on top of that if you met certain prevailing wage and apprenticeship labor requirements for these.
So that gets a little bit complicated.
It's a little bit more now than it was before, but at the end of the day, what we have to do is when we're looking at new projects, if they don't get the bonus deduction, then it's going to be that standard deduction, probably of about $1, anywhere from $1 to about $1.16 a square foot. Again, each year is different. I think it's 2023 was $1.07, 2024 was $1.13, and 2025 is $1.16. And then 2026 inflation adjustments just came out at $1.19. And so, they're going to get a deduction. It's just unfortunate that now they tied the bonus part to labor requirements instead of really making it where I think they missed the ball here. They should have increased that energy efficiency requirement instead of being 50% energy efficient. For every percentage you go up higher, you get a larger deduction. So the deduction requirements though have been all the same, since 2006. It's still the goal is to get to 50%, but it's just the amounts have changed based on the tax years and recent tax law.
And let's hope they don't increase the standard so that it rules some people out. And if you've got a 40,000 square foot building, if you saved $1 a square foot, that's still a significant amount of money.
Yeah, it's going to be something that you didn't get before. It's really kind of a no-brainer. I mean, you might as well take the deduction while it's still available.
Absolutely. So let's zoom out a little bit. Let's talk about where 179D fits into a larger tax strategy and kind of tee up a little bit about where we're going in the next episode. So how does it fit into the tax toolkit for a typical building owner or developer, especially alongside cost segregation?
It obviously works with cost segregation. You're able to accelerate these deductions into year one, along with bonus, as long as we start this prior to the June 30th deadline of this year. But again, it's two different buckets of costs that we're pulling from. Again, with cost seg, we're pulling from 20-year. From 179D, we're pulling from a 39-year, and we're moving them all into that year one. and getting that really large deduction. It really kind of puts people in a position where, they are mitigating their taxes. And also you got to think about how much money you're saving from that tax standpoint. When we look at this, when we've done different shows for the self-storage industry, we've always kind of explained that if you do a cost seg study and a 179D study on your self-storage building, they estimate there's enough tax saved in the first 3 years to put a down payment on a new self-storage project. So when you're planning for this stuff, is that think about how much money you're saving in taxes that can go towards your next down payment on another property.
So if somebody's planning a project and they know they can get started, or at least pour the foundation or get started before June 30th, when is it the best time to call you or me and get us involved in it so that we can get everything teed up for them and get started?
So normally we would really come in towards the end of the project because we can't do any modeling until it's almost complete. But when we got people that are really coming up against this deadline and wanting some advice on when to start, how to start, I would say the sooner the better, because again, this timeline is going to be tight. We only have a few more months before we get there, so they'll probably want to talk with us as soon as possible to figure out if there's ways that they can kind of get grandfathered in through different purchases and try to meet that 5% of at least cost. So
but the project does not need to be done before June 30th.
No, the project can go through. There's no time limit on that as long as the construction is continuous. If they started in May of this year and they finished 3 years from now, they're still going to be grandfathered in.
And we can still do the study. Okay. So how, if in any way, do D fit into a project that would also benefit from R&D credits, since we're going to talk about that next week?
So we have kind of what we call the hat trick, here at CSSI, and that's if you're able to bring in, a client that does cost segregation, 179D, and R&D. Now, with regard to cost segregation and 179D, obviously that's going to be for the real estate portion of our client's business. So that's strictly going to be for the building, but sometimes our clients that we do cost seg studies and 179D studies for, they also own the business that's inside the building. It could be a manufacturing business. And so in that case, not only are we looking at doing tax benefits for the real estate portion of it, the R&D side can actually potentially benefit the business that's inside that building itself and provide another tax credit that they may not have been aware of.
Have you seen businesses in the real estate world that, have their buildings and everything, but also qualify for R&D in the business world? And I know we're getting a week ahead of ourselves, but
from a standpoint of just real estate, not really from an R&D standpoint. But again, if they own several buildings and they own the business that's inside the building and the business is doing R&D, again, it could be a manufacturing facility. It could be an engineering firm that owns an office building and that we did a study on, but they also, lease the building for themselves. We've done several buildings like that where they take both benefits. It's just going to go to two separate entities. One will go to the real estate and the other will go to the business.
Excellent. I don't want to get too far ahead of ourselves. That's why we're treating today as part one with Brian. This episode's all about 179D and the June 30th, 2026 window. Next week, we'll bring him back. We'll walk through the R&D tax credits. So subscribe now if you don't want to miss that follow-up and be notified when that episode drops. Let's give people some clear next steps and a couple of questions we get all the time. And another question that I was going to ask you is, we can actually go back to previous projects with this, right?
Right. The one thing about 179D is that we can actually go do a study all the way back to the first year it was enacted in 2006. If the building was put in service in 2006 or later or renovated, we can do a study on a current return. There's no amending 9D unless we are dealing with a designer. But for building owners, you can catch up that deduction on a 3115.
Just like a cost segregation study.
Just like a cost segregation. In fact, if you do a cost seg and a 179D study, you can do both adjustments on the same 3115.
Oh, that's convenient.
Prior, it was about 3 years ago, they changed that where you had to do separate ones, but now you can actually put them on the same.
Very good. So if somebody thinks they have the opportunity to do a 179D, either for a current project or a project about to start or a previous project, what are the first 3 steps you want them to take right away this week?
I'd say let's get a hold of you and let's talk about the building size. It's got to be a commercial building, or if it's a residential building, it's got to be 4 stories or taller. We want to know, what the square footage of the building is, and what year it was either put in service or the renovations were complete. And with those basic steps and basic information, we can probably put together a pretty quick proposal to give you an idea of what the benefit's going to be, and move forward with the potential study.
With that, we don't even need building plans at that point, do we?
Not at that point. Not at that point. If you move forward, we'll need them then.
Asking people for building plans sometimes throws a wrench in the works. I know for cost segregation it does.
The benefit first, and then they, well, you know what? If it takes me 10 minutes to grab those building plans for $50,000,
it's worth it. Absolutely. Here's a question that I got from one of our listeners. They said, we upgraded lighting and HVAC in a 150,000 square foot building last year. Our CPA mentioned depreciation, but never talked about 179D. What can we do and what should we do?
Well, I think that we should probably talk. I think that the benefit there for a 150,000 square foot building, if it was put in service in 2025, that the deduction could be as low as probably about $170,000 on the low end. And then on the high end, if met with prevailing wage and apprenticeship requirements, that could be over $850,000 deduction. So there's some other things we have to look at with regard to cost. One of the things that we don't have to worry about with new construction is that the deduction will never exceed the cost of the project, right? If you have a new construction building, you're not worried about that. However, with renovations, though, the renovation cost or the deduction cannot exceed the renovation cost. And what that means is that you can't just change a few light bulbs, spend $10,000, take a $100,000 deduction, right? So majority of the time, we've only actually had one problem with that in the past. And that was on a really, really large multi-story building where I think they did about $4 million in renovations, and they had about a $4.5 million deduction. And in that situation, they were only able to take a $4 million deduction because the deduction was larger than what the renovation cost. So they were limited by that.
That's the majority too bad for them. Only a $4 million deduction.
Yeah.
So let's land the plane here with a quick rapid fire round. I warned you about this. Some myths, some hot takes, and some quick answers. I'm going to throw out some statements. You tell me true, false, or it depends, and give me a quick explanation. 179D is only for new massive commercial buildings.
False.
Okay. If your CPA hasn't brought up 1D, you probably don't qualify.
False.
We know that's true. We know that's actually false. With the big, beautiful bill ending in D for new projects, it's probably no longer worth digging into.
After June 30th, it depends, right? After June 30th, they're not going to be able to qualify. But prior to that, let's look at it.
And it's getting to the point now where if they're going to do major renovations, they better start planning them now if they want to get started before then, right? Brian, this has been great. Let's wrap up with a quick recap and clear the next step for everybody listening. This has been a great opportunity to learn how to turn energy efficient buildings into real tax savings. So today we broke down what 179D actually is, who qualifies, the type of projects that can trigger big deductions. We walked through real-world examples where owners unlocked serious savings from work they'd already done, and we dug into the mistakes and myths that cause people to leave money on the table. More importantly, we talked about timing. Under the big, beautiful bill, 179D is effectively ending for new projects, but you can still have a powerful window for it. If your project starts before June 30th, 2026, you can still position it to claim 179D. If you own or design commercial buildings, don't wait. Call or email me right away for a free 179D analysis of your building. Make sure every qualifying project that starts before that June 30th cutoff is evaluated. To help you do that, I've put together a free one-page 179D tax deduction playbook. It gives you a simple overview, an eligibility checklist, and the exact questions to ask your advisor. You can grab it right now by subscribing to the Tax Strategy Playbook newsletter. One more thing that I didn't ask you, Brian, and I'll make sure I want to cover this in this episode. You said that for a government building or a nonprofit, the benefits can be assigned.
Right. So The governments and the nonprofits, they're non-tax paying entities. They don't have a cost basis to apply the deduction to like you would a building owner. So basically, since that deduction can't be used by them, they get to assign it or allocate it to the designer of that building. Basically, your architect, your engineering firms are who we're looking at that can qualify. Now, one big difference, though, with the designers and getting that deduction allocated to them versus a building owner is that building owners can technically go back to 2006 and claim it on a current return. With designers, they basically have a 3-year statute of limitations, just like any other taxpayer. So that's the two main differences, with the allocation letter and the 3-year statute versus building owners can catch it up on a current return, regardless of when it was put in service.
So would the designer or the engineer or the architect, would they pay for the study? Because why would a building owner want to pay for a study that they're going to assign the benefits to somebody else?
Right. So the architect engineer does pay for the study because they're the ones who benefit. And we work with them on the allocation letter. And so when they're going to this government entity or nonprofit, we usually talk to them up front to let them know that we're going after the deduction, and we got to make sure that deduction is still available, that it wasn't given away to somebody else already. And if it's still available, then we just confirm that they're going to be able to allocate it to us. And really, it's just a letter that we fill out and they sign that says they're giving the deduction to this designer for their energy efficient designs.
That'd be huge for the companies that build schools or government buildings on the regular. They would benefit greatly from that. And
there's no recapture. No recapture on the designers. That deduction gets to carry out until they use it all, unlike potential building owners that might sell down the road.
Gotta love that.
Mm-hmm.
Thanks, Brian. That I wanted to make sure we got that in this episode because that's big. If you got value from this episode, I got 3 quick favors to ask of you. Number 1, subscribe to the Tax Strategy Playbook on YouTube, Apple, or Spotify so you don't miss the follow-up episode with Brian next week on R&D tax credits. Number 2, subscribe to the Tax Strategy Playbook newsletter. You'll get free resources, including my 2026 tax planning guide and my 179 playbook, along with access to mini episodes and future live streams. Go to taxstrategyplaybook.com to sign up, and it doesn't cost you a thing, just your name and your email address. And then share this episode with one investor or owner or designer who's working on a project and needs to know about 179D and the June 30th, 2026 window. Brian, thanks again for joining me.
Thank you.
I'm David Wiener, Mr. Cashflow, and this is the Tax Strategy Playbook, where we turn the tax code into your competitive advantage. I'll see you in the next episode with Brian to talk about R&D tax credits.
See you next week.
Thanks for listening to the Tax Strategy Playbook. If you found today's strategies valuable, be sure to subscribe, leave a review, and share the show with someone who wants to play smarter with their money. You'll find more resources, tools, and expert tips at taxstrategyplaybook.com. After all, it's your money. Keep more of it.